Thank you very much. And look, I echo the comments made by everybody earlier, Toby, Stuart. I do recall when we were first trying to accelerate the ETF market in about 2005, 6, and we used to gather in rooms not as big as this, with fewer people, and frankly, half the time we confused ourselves talking about EFTs and not ETFs. And so I think it's important, and I acknowledge the work done by Damien and Toby and their teams to get this idea to become live. Going from 0 to 1 is always very, very hard. And so I think we'll look back in years to come and go, remember the time we stood around in Sydney and Melbourne in March and talked about direct indexing. Let me talk a little bit about indexing. Stuart had a good definition there. MSCI has been involved in indexing for 40 plus years, but frankly, it caught us a little bit by surprise in the US about 4 years ago. And the reason was we've been doing this, giving clients recipes for equity indexes forever, but we never really thought there was an application to wealth. And I'll talk a little bit about some of the drivers there around technology that's really brought this into the space for wealth for advisors and platforms. And just on indexing generally, I mean, it is a very powerful tool. It's a powerful tool for investing because it does a number of things. It has a set of criteria that enables an investor to build and capture the things they want in their portfolio and exposure. They rebalance regularly, normally quarterly. So you're always moving back to what you think is most important to be captured in your portfolio. And that's important. You don't get what we call style drift. And I think it's also important that increasingly the shift has become not market cap driven, but how do I build a custom solution that actually reflects different criteria. Stuart talked a bit about ESG and factor and style factors. So the whole idea of indexing we've been doing forever. It caught us a little bit by surprise, but we're very pleased. We are big supporters of direct indexing. Ironically, in Australia, I'm not sure if that's the ideal term because I think given that managed accounts have been around for decades, to me and to us locally, it looks more like a systematic managed account for equities. But we'll go through exactly what that means. Touch a bit on MSCI in a moment. And so we do a lot in the US. We think the early shoots are happening in Australia, and I'll talk a little bit about why and what we saw in the US that looks early days familiar and similar locally. And I'll talk a little bit about how we actually give solutions to clients to be able to build it themselves. Rather than have us tell them how it should look, that's not what we do. How we give them the tools to be able to build the solution they think makes sense for them, for their client, for their portfolio. I mean, it's interesting, having been involved in the ETF industry for probably 20 years. Over the years, I've regularly had people come and say to me, how do we get into the ETF issuing game? And I pretty much always said, I don't think you want to be in the ETF issuing game. And they go, no, we do. Normally a wealth firm with size. And when we dug a little bit deeper, it wasn't that they actually wanted to be in the game, let alone understood the complexity of having an ETF issuing platform. What they wanted was a level of customization around what was publicly available on the exchange. And so direct indexing now gives that recipe of customization to anyone who wants to be able to utilize that and then go and find a way to implement, report, manage, custody, and so on. So let me touch a little bit on MSCI. I'll switch sides. And look, some parts are probably well known for MSCI, other parts are below the surface or completely new. We're a US listed firm. We're probably 75 billion market cap. Been around for about 45 years. I get in trouble for marketing because the numbers on the left-hand side there are out of date. But at our core, we do two things. We help clients to measure risk and understand risk, and we help clients to measure performance and understand performance. And then we do that captured across three product groupings. On the left-hand side is indexes, and I'll talk a lot more about that in relation to today. We provide a whole range of tools to analyse, manage, monitor, report, stress test, understand liquidity in portfolios for clients. And then more recently, in the last 7 or 8, 9 years, probably, we've done a lot more around ESG and climate. And the reason why those 3 groupings are relevant to today's session around direct indexing, they are the ingredients that we're seeing clients want to understand, and then how they can apply them to their index and then hand off that portfolio to be managed. And then on the far right is private real estate, which is actually bigger than that. It's broader than that. It's now infrastructure, private credit, private equity. And so, as I mentioned, we've been doing direct indexing solutions for institutional clients for decades. And so the biggest super funds, the biggest endowment funds in the US have been asking us to customise primarily equity indexes for them, to build in the criteria they think are relevant for them. What we didn't probably see coming as quickly as it has in the last couple of years is around the wealth market. And I think there are 2 drivers there, not only the desire to customise a portfolio, but also the ability of technology to deliver that at scale and at smaller balances. So Stuart talked about fractional, but largely the growth in technology, and if you think about that from an Australian perspective, you know, the ability of managed account platforms to be able to do all the infrastructure and provide all that, which traditionally used to be held more institutionally. And so wealth's all of a sudden gravitating rapidly towards these ideas. In the US, we see a number of drivers. One is they may want the customisation if they have certain views in their research business that they want to overlay into the portfolio. We want to tilt away from a certain country. We want to tilt towards particular ESG criteria. We may want to allocate more towards a particular style factor, momentum, quality, value, small cap, and so on. And the other part is if they can remove the wrapper and access just the recipe, that may give them a way to potentially shift some of the margin in the value chain towards themselves. And so we're seeing that alive and well in the US. At the moment, it's still heavily offered by institutional clients and private wealth firms, large private wealth firms, or they call them RIAs in America, registered investment advisors. And they look more like asset managers, particularly for wealth. But they are moving down and utilising direct indexing solutions, particularly for equities, as we speak. The move towards potentially mass customisation is also coming over the horizon too. So Schwab, who's one of the big online brokers in the US, is moving down this path of offering these solutions. Now, you know, we're early days in Australia, I would contend, but I do think that's the end goal. As Stuart said, everybody wants their own customised portfolio for their own customised needs and their own customised views. We're a data firm at our core, so that was about as briefly as I could get marketing to condense that definition. But clearly it's about delivery of personalisation and delivery at scale. And I'll talk about the role that MSCI plays. So we largely think about 5 steps that we help clients think through to arrive at a portfolio or recipe that meets what they're after. So we talk about a starting point. It could be MSCI Australia 300, it could be MSCI World, it could be MSCI Emerging Markets, it could be even broader than that. But we need a starting point to then make changes to that index through time. We can design what the client thinks is relevant. Again, it might be ESG criteria. We're particularly seeing that in some parts of the US, although as we know in the US, ESG is very localised. If you're in Texas, you may have a different view from California. But generally, some of these globally recognised criteria around style factors. So how do I tilt my portfolio for my client towards quality stocks, for example? We then enable them to constrain parts of the index by limiting the number of securities. They could constrain the size of the largest holdings. They could remove elements that they may not want in there, be that countries, sectors, and so on. And then we give them a way to think about even more complexity, should they wish, around how to manage things like tracking error. Do I want to control tracking error? Do I want to control turnover in my index? And what's the frequency of rebalance? So again, the role that we play is really confined to delivering a client the recipe they want. And then we work with them on the ecosystem to deliver that file or that recipe to their partner who can do the trade, do the execution, do the reporting, and so on and so on. But there's a bit more complexity sometimes to indexing, as all indexes will tell you, around corporate actions. But part of where MSCI has the rigor around institutional quality, you know, we maintain 300,000+ benchmarks a day for clients around the world. The fastest growing part of that 300,000+ is customization. So 20 years ago, the world was very market cap weighted. And generally the way we think about the starting point is market cap weighted. Largely for our indexes, that starts by working out what's the available free float and liquidity in any particular market, call it Australia, and then we weight by size for the index. But that's not the way many clients view the world now, and particularly not in wealth. So they want to be able to weave into the recipe their own criteria. So in the US, we have seen some of the drivers. We were talking about this on Monday around tax. Look, I think certainly tax is a driver around direct indexing in the US. And again, there are idiosyncrasies around carried forward losses and, you know, end of financial year sort of washing out of gains and losses. But I don't think it's really that much different to Australia. There's clearly a desire in Australia around having greater control of tax outcomes in a portfolio. And we see that being delivered primarily by the platform, whatever that platform is, and I'm using the term fairly generally. That's not the role we play. We can help clients think about that through our index construction process. But early on, the big driver was around tax in the US, and now it's more around customization. So let me just jump quickly through the tool that we have available in the US, and we're going to bring to Australia shortly, that gives clients the ability to work their way through what they think is relevant and what comes out the end in terms of the recipe for investment, or what they might want to change and amend. And there's a raft of them. You know, they may wish to think about things including or excluding certain GICS sectors. They may wish to include or exclude certain countries. They may wish to allocate to style factors, as I mentioned, quality behaviour, value, momentum, high dividend, and so on. Increasingly, we're seeing for the some of the direct indexing usage in the US, if a wealth firm has a particular view around thematic and it's got a long horizon around it, how do I actually do that? And it might be healthcare, it might be biotech, it might be AI. And so there's many different ways to think about, you know, what are the criteria that are most relevant and how to be able to have a play with that. So here's an example, back to the 1 to 5. Here's, I have my starting index. I might wish to increase my ESG score, and I won't go down that path because it's probably another half a day session coming up. But I may wish to improve the ESG profile of my equity allocation by the index. I may want to take out casino and gaming stocks, and I may want to cap the number of stocks. That may be due to size limit. That may be just it's easier to have the discussion with the client. And so that then leads them to be able to have more design options around what they think is relevant. So here's the tool. I'll show you a couple of screenshots. But again, we think about the world in a very data-driven, systematic manner. And so having a process to be able to build a customised index solution is pretty important to make it easy and user-friendly. And so we've done this. I'm sure other index providers do have similar tools, but this is the one we've made available in the US. And again, I was joking earlier, we, as a data firm, we tend to sort of say in 2,000 words what really should be said in 200, but we built that tool really for wealth because wealth had a slightly different need for a user front end to be able to run and drive some of this technology. Ironically, institutional clients now go, that looks really good, why didn't you give us that years ago? So clearly, some of the UI criteria are exactly the same between institutional intermediary. We produce a whole range of output to give some academic and investment rigor to what actually comes out of the recipe. And that's the part where we deliver that to the client to then be able to deliver that to their ecosystem effectively. So we hand off that file. That can be delivered many ways. And then it goes to their partners to be able to do the implementation, the monitoring and the reporting. And every day we monitor the corporate actions, and every quarter we rebalance the portfolio. Now, what we have a couple of clients in the US doing is saying, we're a bit more like a broker, so we have a changing view on a regular basis around tilts in the portfolio. One client in the US actually reallocates or reruns their index every 6 months, depending on the changing views they have. So their views may not have been around mid-cap stocks for their domestic equity index with a range of other criteria. They may have a view that now small cap should have a larger weight in the portfolio. And so again, this ability to continually customise is available. Again, impossible in years past if all your implementation vehicles were only mutual fund or an ETF. But now, customisation has been accelerated by the massive growth in technology and delivery. I'm probably getting close to time, am I, Toby? I didn't bring my watch. Do I? Okay, cool. Okay. I'll pause there for a minute. Are there any questions off the back of that?
I've got a question which came out of from Monday. But do you want to go back to one of the screenshots of the of just your little talk? Yeah, that one. So thinking about that first column, which is pick your BISR exclusion. I've got no idea what BISR means, but I presume it's some sort of set of filters on stocks. I presume that area there of being able to identify the characteristics of individual assets is sort of embedded in that.
Correct. So that is an actual ESG that actually identifies the business involvement activities of any company. Largely looking at their footprint, but also their revenue lines. So clients may wish to not be in gambling and tobacco, and that's a way for them at the early start of the process to be able to pull that out. In fact, I might have a slightly better illustration of that. I'll just touch on this one. So here is, I understand that advisors are generally asset allocators and build long horizon asset allocation portfolios, but we do see in the US particularly the wirehouses, which are like large broking firms, they are trying to get their research views into the equity portfolio on a recurring basis. So again, they're not building long horizon portfolios solely. They may go, our short-term to medium-term view is around the following thematics or the following ideas out of research. They probably used to do it largely by single stock criteria and implementation. They can now do that in a much more effective and actually a much more robust manner by overlaying those views onto a larger set of
What's the sort of cost involved in this for the client? I mean, does MSCI charge a subscription fee for access to that customizer, or is it a flat fee, or it gets built in as a basis point in the investment? And does that fee or cost alter depending on the level of customization, or is it sort of a more flat fee regardless of customization?
Yeah, it's a good question. Thanks, Pete. So the actual tool doesn't have a cost to it. It's more a means to try and help clients understand. And in fact, that clients that are currently using custom indexes through MSCI actually use that tool to then sort of work out what's my pre and post if I make changes. But largely it's broken down into two components. It's got a sort of an annual fee component around the maintenance of the index. And then it's got a basis point fee attached to the replication.
Okay. And does that alter depending on the level of customization? Or?
So what we've done for wealth is, for the institutional market, it was by index, by level of customization. What we've done for wealth now is go, you know what, if you have a sense on what you need over the next 2 years, you know, if you need 3 custom indexes because you're putting most of your client money into a, you know, one of 3 equity choices, or if you have a need for 50 or 150, we'll basically build a sort of a range in for that fixed fee. And so Schwab, for example, you know, they've got needs around much higher volume as they're doing customization for a lot more DIY investors.
Thank you.
Let me just spend a couple of minutes on this. It might be a little hard to read, but this is really sort of the tool. I was going to do it live, but then I got a bit nervous about doing it live. From several years ago when I did one live, and it was DOA. So remember those 1 to 5 sort of steps? This one says we've done a sample. This starts with All Country World Index as the starting point, and then it gives you a whole scroll down of how many names and weightings are in that index. Now that's a market cap index that covers developed and emerging markets, large and mid. And then clients go, okay, well, that's great as a starting point, but I can buy that on exchange as an ETF quite happily. What's really important to me here is to take out things like maybe Australia. Maybe I want to manage Australia actively, or I have a different way I want to play Australia. So I'm going to take out Australia. I'm going to take out some exclusions. I'm going to take out BHP for some reason. Now, it might have been a corporate director of BHP. I think that was just trying to prove the case that you can pull out individual names quite easily in this process. So it then sort of screens down to what's come out through that step. Next step then says, do I want some control over the size? I don't want NVIDIA being in there at 12%. Maybe I do. I don't want too many stocks in there, so I want to constrain that to maybe 40. And I want to cap some sort of weighting by security and the number of securities. That then says, how often do we think we need to rebalance? Now that's somewhat art more than science. Depending on what they're trying to do, the client will work out, is the payoff by changing the market cap benchmark short, medium or long term? And if it's a longer term, maybe it makes sense to do it every 6 months. But generally, clients for any index tend to rebalance every quarter. We then come back to, Toby, as you mentioned, what we call BISO, which is really just sort of an ESG criteria for screening certain behaviours. This sample took out coal and fossil fuel, which is relatively common institutionally. it may or may not be a driver for some wealth firms. So we step through that. I won't go into the great detail. That focuses more on, and you're seeing this growth in the ETF market around style factors now. Style factors isn't the term that's often used in the ETF or the retail or wealth market. It's probably more recognised as smart beta, but I want to allocate to stocks that have more behaviours that reflect momentum, yield and size, for example. So again, these are often investment criteria that wealth's tried to capture by a single stock or by an ETF that may have some sort of mismatch between exactly what the client's after or the home office is after. Do all that, run all that, and then the output is quite extensive in terms of, does it seem to work historically? It's a systematic process, so there is validity in back testing. So really just trying to give clients really the insight around, does that make sense? Does it not make sense? What sort of reporting is available? And then the final stage is we then help engage with their ecosystem. So it might be sending the file by API to Financial Simplicity or managed account platform. And then we obviously do the rebalance and so on, the monitoring, and then step back because the reporting and the maintenance and the discussion around investment outcomes we can support with output. But generally, that's the role of the advisor and the dealer group. I'll stop there. We've got Q&A later, but I just wanted to sort of recap. So, these ideas are alive and well in the US. They've begun very institutionally, and they're moving now down into sort of more mid-market wealth. I don't think it's mass customization yet in the US. That may be the holy grail, but at the moment it's how do we actually have more control over the investment allocation we're putting clients' money towards, with the view that the IP of the individual advisor or the firm can actually appear in the portfolio. And then the other driver that we've probably all underestimated in every aspect of our life is just the sheer pace and rate of change around technology. I'll stop there.
Questions? Yes.
Thank you. That was an interesting presentation. Just a quick question on the back testing. Is that a fixed set of weights that's been taken back historically and then projected forward, or did you simulate that rebalancing?
So the back testing is the same criteria with a reweight probably every quarterly if that was required, mandated in the set of criteria.
And that's simulated quarterly rebalancing based on the prevailing conditions for the back test.
That's right.
Okay, thanks.
Thanks, Tim. I was interested when you brought up the screen with the screens on it, the options that could be chosen. How do you convey the definitions of those? For example, I think one of them was coal or fossil fuels. I guess some issuers are having problems recently with some confusion around what they're actually applying there.
Yeah, so all the criteria are based on the MSCI data sets to determine coal, ESG, climate, any of those criteria, style factors. So we use our own criteria. It's not open architecture at this point. That may happen at some point, but generally it's driven off the MSCI IP. We do.
Just to clarify, you see this as an input into something like Financial Simplicity. That's a portfolio.
Yeah, correct. Yep.
So I guess sort of flowing on from that, what other, would it input to a platform? Have you had those kind of conversations? And I guess for Stuart, especially in the super environment in retail, can you just talk to what are the typical execution and custody platforms that you kind of lead into? What's, you know?
In the super world today, we're connected with most of the major platforms that feed essentially portfolio data, as in the composition of all the portfolios, and they feed that into our engines that the wealth managers then can apply their models, which could be index models or customized index models, and then uniquely positioned, they can also then tailor it down to each individual client and their tax situation. So then you can give it this very, very precise, personalised investment management, and that can then make all the decisions in a pre-compliant way that can then feed trades back into the platforms.
Just from like we've been doing it on super, we're on 2 different platforms at the moment. We find outside of super, it's much easier in that we can get we can do the exclusionary stuff within super. A lot of the, when you start dealing with the REs and various investment overlays over it, getting the tilts in where you say, okay, I want extra quality in this, or I want whatever, nuclear power, give me 5 nuclear power stocks or whatever. That tends to be, the ones we've dealt with so far, it's there, but it's expensive. They go, oh, well, that's another portfolio you want. And then you've got to go through the compliance perspective of running, 100 different more portfolios, and they want to charge you for that pleasure. Whereas outside of super, we'll talk about structures more, that you can do a lot more at the moment. But fundamentally, I can't see a reason why if you've got the REs and that over the line on what constitutes proper management.
I think the key point's probably one that Tim just made, which is this is progressively coming down towards retail investors. If we're thinking how might this play out in the next few years, we're still at the kind of high net worth or non-personal investor set, rather than this degree of complexity at the mum and dad level.